here with Discover Options and OptionVue. Welcome to this presentation of Stochastic Condors. Stochastic Condors. This has always been something real intriguing to me because, one of our main strategies we teach here at Discover Options is the Condor, and we have our certain way that we like to campaign style trade the Condor, and we've had great success. Our students have, our mentors have, not only in their own accounts but in the accounts that we manage for others. But there's a little bit of a twist that is occasionally taught out there, and something that I know that our mentors toy around with a little bit, and that is this. It says audio breaking up. I'm sorry. Okay. All right. We'll, Bill and David and Adam, let's just see how we do here, okay? Sounds good to me, says Greg. Excellent. Okay, audio's fine. So interesting. Okay, who knows about, maybe it's the internet connections and the bandwidths that each individual person has. I know in my home, if over Christmas, just as an aside, over Christmas break, I had all the college kids home, and they like to play games and watch Netflix. Anyway, our bandwidth was taxed all the way to the max. And when some kids would be watching Netflix and then another one is trying to play his online game over, because they all bring their laptops home, right? And they're tapping into the same Wi-Fi. It was kind of you found out real quick how crowded a Wi-Fi bandwidth can get there. But as I was saying, in the world of condors, you typically, quite often, you put it on at once. You put on the credit spread and the calls and the credit spread and the puts all at the same time typically. And certainly that's our core strategy. That's what we do. And we do it, not only do we do it at the same time, but typically the same time every month. And but we're hearing a little bit more from students interested in this approach, and so what I am attempting to do here today is to kind of codify an approach whereby you leg into one side above the other. So let's just, without further ado, get right into this, okay? Stochastics is a part of technical analysis. It's kind of a technical term, but we're just going to get in and talk about stochastics, and then we're going to talk about condors, and then kind of bringing the two together in a concept. But the notion here is that we're going to leg into the condors using a slice of technical analysis here, okay? Now, without further ado, let me go into now I'm going to try and work on this. Let me hit next, okay? Here's a typical disclaimer, folks. If you haven't yet gotten this brochure, Characteristics and Risks of Standardized Options, I just want to remind you, it's good for you to get that thing because they have a lot of good information in that brochure. Every broker gives that to you, so just a little reminder there. And I'm working on the next button. There we go. We're going to talk about stochastics first, then condors, and then what we're going to do is work it towards a set of rules that you might consider using stochastics to leg into your condors with, okay? What are stochastics? And, I'm quoting this fantastic universal source called Wikipedia. Sometimes people joke about Wikipedia, and for good reason. In some topics, it's kind of weird. But sometimes when you Google a topic and you look up what Wikipedia says, some people have taken a lot of good time to efficiently articulate definitions. And I thought this was about as good as anything to articulate the definition of this. The stochastic oscillator, it's a momentum indicator used in technical analysis, introduced by George Lane in the 50s. And this is the key part. It compares the closing price or the current price of an asset to its price range over a given time span, comparing the current closing price, the current price of an asset to its price range over a given period of time. And so we're going to flush this out and make sure we thoroughly understand stochastics. Then we're going to apply it to the world of legging into condors. Boy, and I'm just used to clicking a down button. All right, just a sec here. All right. All right, we're going to hit the next button. Perfect. All right, so what are stochastics? This is a fantastic indicator. If you're not already familiar with this, you should know this is a very flexible indicator that you could use in several different ways. Short-term or long-term outlook, you can use it to confirm trend. You can use it in the world of divergence, looking for market tops and bottoms. You can use stochastics to determine pullbacks. And what we're going to discuss today is a little bit more the whole notion of determining overbought or oversold conditions. That's kind of what we're going to focus on. But you should know that if you learn stochastics, that you can really construct a trading methodology pretty much centered around the whole philosophy of stochastics. Now, here's what you get when you dive into this world. There are two measurements you should be aware of, and that is %K and %D. All right, %D, going to the bottom here, is just a simple moving average of K. So we have to really focus on what K is, because D would be the trigger line. And all this is drawn, of course, underneath your price chart. So let's just focus on K. All right, you take the close minus the low over a certain number of days. So let's say N is equal to 14, and 14 is the default setting for N typically, is 14-day look back. So you take the low over the last 14 days, okay, and you take that number away from the current close. You divide by the high over the last 14 days minus the low over the last 14 days. You take that value times 100. And that's going to give you a value between 0 and 100. Okay? And we're gonna graph that. So let's just examine this. Here I go again with the clicking. Okay, there we go. Let's look at this. Now here, yeah, this is kind of what happened here. I had covered all of this, and I had these individual little numbers being revealed all at strategic times during my presentation. So now I'm going to go get a pencil and kind of explain what all this really is. So let me grab a, let's see. Again, this is the first time I'm using this venue, so let's take a look. Okay, so %K, I'm going to highlight that. We're going to take the close minus the low divided by the high minus the low. So here we are. We're going to evaluate what stochastics is, what the stochastic measurement, what %K is as of right there, with the close at 1380.95. So follow me here. The high over the last 14 days was right here. The low over the last 14 days was right there. And when you plug these values in, okay, what you're going to get is a value of just 1.5. What that means is that the current close is very, very close to the 14-day low. See that? And that's where you're looking at, on a scale of 0 to 100, how low is the current close relative to the range? Well, it's at about a 1.5. That's another way to look at it. Okay? On a scale of 0 to 100, how low is the current price over the last 14 days? Well, we're at about a 1.5. That's about as good a way to explain it as I can think. And so sure enough, you look at the stochastic level down here, we're at a 1.5. We're very close to that 0 level. It's very, very low. All right, so let's click and go to the next slide here. So I think you kind of get the picture. And this is the stochastic oscillator here. This is just %K that we're drawing here. Currently, we're at a 1.5. All right, now, so just follow me here. We're going to work our way towards legging in the condors efficiently here. All right, so now let's look at this example. We're looking for %K. We take the low, and so here we are up here. This is the current close, this little red dot there. We have the 14-day low here, the 14-day high here. On a scale of 0 to 100, how high is the current price? Well, when you run these numbers out, now it's interesting. Is this going to let me click there? No, it didn't. It didn't remove this slide here. Interesting. Okay, we'll have to work on that. Yeah, I had this little screen being removed, and we would have seen the stochastics, you know, coming up, and then we were finishing at probably what, a 5.71, something like that. On a scale of 0 to 100, it would have been at 94.29. On a scale of 0 to 100, we're at about a 94 in terms of being high like that. So here, percent K would have been very, very high. All right, so what you should note here, here's the 14-day, and we call this a fast stochastic, just like what I showed you. And typically, you'll note when price is really low for its 14-day history, here it is getting close to 0. When it gets high relative to the last 14 days, well, now here we are over, you know, over 90, certainly over 80, pushing near 100 there. Now, in the world of stochastic indicators, you should understand what fast versus slow means. Fast stochastic means we're taking this percent K and it's just raw data, just like what you see here. What we're going to do is I'm going to show you what slow means. Slow means we're going to take a moving average of this raw data. We're going to take a moving average of that raw data, and in this case, we're going to make it. We're going to take the 3-day average of it. We call that a 3-day slowed stochastic. It is still called percent K. All right, it's still called percent K. It's just that we're operating on a setting of 14-3. It's a 14-day look back, but we're taking the 3-day average of that raw data. And that is our percent K right now. And you can kind of see as the market, you know, the stochastic goes up, the percent K goes up. As price comes down, so this percent K comes down. The line's a bit smoother because we've taken a 3-day average of the thing, right? Okie dokie. So now you know what fast versus slow means. Now let's continue here. Now, here we go with the percent D. Our next step is we're going to look at this smooth line, and we're going to ask for a trigger line. So let me just draw a little something here. Let's see here. Okay, I'm going to take a different color, and I'm going to change the width. Let's see, is that going to be, yeah, there we go. And what we're going to do here is take a moving average of this slowed percent K, and we're going to take a moving average here, all right, like this, and apply it to this portion of green so that you're going to have little crossovers here. It's called a trigger line, where it's also called percent D. So when we come here, we're going to take a simple moving average of that smooth K, that slowed K. This will be a 3-day average, and there you can see it right there. Okie dokie. Now, what we do then is we're going to how would you draw the settings here? It's a 14-day look back, slowed 3 times. That gives us the blue line that kind of smooth. Now, we're going to take then -3 means that we have now our 3-day moving average that is the trigger line. See that? And that's what you're looking at here. And so what we do now is with that trigger line, you'll see that. Now let me just kind of take a preview, okay? Now let me come back. And I'm just getting a preview here. Perfect, okay. So you can kind of see where you have crossovers. We'll get into that. That's where you could have little signals telling you the market's now, you know, going down and then up. Here's a crossover here to going up, and so forth. Now you can change these settings. Whatever you're using, whether you're using OptionVue charts or, you know, any other charting program, you're going to have a stochastic setup screen. Here we're using a 14, 3, and 3, and I'll tell you what, I'm going to change this in just a second. For the use of condors, I'm going to tell you, we're going to use a 5, 1, and 1. 5, 1, and 1 will be the settings we use for condors, but I'm using 14, 3, and 3 only because in most programs, something like this is typically the default settings that you'll see, including OptionVue and other programs. All right, but for just giving you a little preview, we're going to use the 5, 1, 1 setting for the use of condor legging in. Typically with a stochastic, here I changed it. I had another system years ago that I was using 15, 12, and 5. Look at that. Look at that blue line. Really smooth. 12-day moving average of the 15-day look back. Very much a smoothed %K there with a 5-day trigger right there. So you just don't get a whole lot of signals when you're using, higher settings like this. All right, and you can kind of see where the crossovers happen with these longer. This is kind of a trend confirmation approach. See, this is a trend confirmation approach where you make the settings much higher, and then that way your crossovers are fewer and farther in between. And when you do have a crossover, quite often you'll have, a nice little indicator kind of confirming the trend for you. All right, so that's one use of stochastics, is trend confirmation. And what we're going to use, something a little bit different. Now, here's the Russell. Here's the 14, 3, and 3. And the notion here is, as I mentioned before with condors, we're going to use this indicator to determine overbought and oversold levels that will help us leg into condors a little bit better. Now, if you were to wait until the stochastic was, say, under 20 or over 80, you just don't have a whole lot of signals this way. And we really need to kind of leg into condors a little bit faster than what this setting is going to give us. So here's the notion. I'm going to change this. I'm going to go to a 511, and while you guys look at that real quick, I'm going to get a sip of coffee. Just a second. 511. Now, what that is saying is we're only going to take a 5-day look back, and we're going to look at where the close is relative to the 5-day range. And that's why you see this thing oscillating back and forth, and you have far more instances where the stochastic is say above 90 or below 10. Far more instances, during a 1 or 2 months time frame than you would if we go back to here and we're looking at the 14, 3, and 3. Here we're at the 5, 1, and 1. And you can see that it swings all the way up, all the way down, all the way up, and all the way down. And for a trader that wants to trade condors and leg in, this could be a good philosophy to use. Now let's see what the next slide shows us here. Here we go. Here's the premise. Let me switch my pencil over and go to the dot, bring this up a little bit. All right. Here's the premise. We're going to sell out of the money put credit spreads, all right, after the market goes down. After the market goes down and is technically oversold and is thus more likely, doesn't mean that it will. We all know it could keep going down, right? But it's more likely to reverse and go the other direction after it's in an oversold state as measured by an indicator like this. After the market goes down, quite a bit over a week, it's more likely to stop going down so quick or even go up. And so the idea is that we're going to wait for that condition before we put on our put credit spread. Likewise, on the upside, we're not going to do that call credit spread until after the market goes up for a bit. Because then after it goes up and is now technically overbought, so to speak, there is a greater chance that it's more likely to reverse and go back down. So this is what we're going to do. We're going to sell put credit spreads into oversold conditions. Then we're going to wait, and or could happen vice versa. Then we're going to wait and sell call credit spreads after the market goes up and is now technically overbought. Now, all this whole premise flies in the face. That's why I say versus, all right? A typical Condor program, and this is what we do in Discover Options, and we have a lot of good ways to trade this, and we have a great track record with this, but I'm just kind of showing you a little bit of a twist. Selling out of the money credit spreads in both the calls and the puts initiated on the same day. All right? And so that's kind of, these are two different approaches. This has great success. Okay? Now, but if you're going to go down the road here, and we've explored this a bit with in our mentoring, just in the one-on-ones, and now getting a little more public about it, this is something we could look at, is legging in. So let's now go to some specific rule propositions here, and then we'll look at a little bit of an example. All right, so here's an initial set of rules, and I'm throwing this out there. Of course, it has a lot of room for alteration, but this is just a good little place to start, and certainly you can individualize it, and I would certainly expect you to. All right, with 42 days to go, and I've heard a lot of people like to go with 60, going a little bit further out in time. We like 35 to 42, but let's just say we're going to start here at 42 days. Let me see here. I'm looking at some comments. Legging in house, getting good feels. Okay. Chris, I'm going to show you just an example. We haven't fully back tested this, thoroughly. I mean, it's. I'll show you some examples here. One example in particular coming up. But for those of you that want to do legging in, this is just a good tool to consider. Here's how it goes. With 42 days to go, you begin the campaign, and you wait. If on that 42, that'll be a Friday. That'll be a Friday. If on the close of that Friday, the 511 stochastic is not over 90 or under 10, well, then you wait until the Monday and see if Monday at the close either one of these conditions apply. But if it is over 90, or on the first day at the close, if it's over 90 or under 10, let's say it's over 90. We're going to sell the call spread at the close, or, okay, if it's under 10, we're going to sell the put spread at the close. See that? And once one of these is completed, you then wait and do the other side. And it could happen with the calls first, it could happen with the puts first, could happen right on that Friday with 42 days to go. Typically, we look at this in the indices, in the Russell. And one thing we like to do is look at the delta of the actual short strike. This is something we like to do. We look at the delta of the short strike that we're going to sell, and we could go to the first strike that has a delta of under 10. Now, some of our students like to go, like to alter this number a little bit, and also we teach using the same number. But the idea here is that you need to have a delta threshold where you're going to sell premium at. And some folks like to separate the delta and have one delta number for the calls, one for the puts, depending on conditions. And you could back test that as an independent variable separate from everything else. Let me see. I'm just looking at a comment here. Yeah, Brian, you have a at that later. All right. I'm just, this thing, you could back test this thing till the cows come home. So many variables. I'm throwing in a variable that is kind of new for some of you. All right. And I like to look at, looking at the stochastic, I think has great merit. But here's what we're going to do. Sell the first strike out of the money, delta of under 10. We're going to do a 20-point spread in the Russell. Some debate, should it be 5, 10, 20? look, the wider your spread is, all right, the lower your gamma will be, and the fewer contracts you will need to use. Okay? The gamma will be a bit lower. Okay? So that's just one consideration. If you go wider on the spreads, then you'll use fewer contracts, and your gamma will be have a little bit flatter of a line there. That's the advantage of going wider. And that's what we're going to do with just these examples. Now, how are you going to exit? Lots of ways to do this. Some students are watching, and you guys know what we like to do. But for our purposes here, just with this example, throwing out the idea, all right, and only because I think it's a good idea. We've been examining some other traders that do this, and we're tossing it around now. The spread, buy back the spread when you're losing money, and one of the spreads, the call or the put side, ends up costing twice it was when what you collected for it. Okay, in which case, go ahead and close out the whole shoot and match, take the loss, and go away, and wait for the next one. That's one way to do this. If one of the spreads, okay, you sell it for $1 and the price of it goes to $2, well then just get out of the whole thing. Period. Now, you could do other things with that. You could roll profits and this and that, but for our purposes here, for the example, we're not going to do that. Now, the other thing to do on your profit taking is when you can close out the whole thing for half of the total credit. Okay, go ahead and do so, and do a yield grab of half of the total credit. So when you're making half of the potential yield on the Condor, grab it and run. Period. Okay, don't hang around till expiration. See if you can get the full spread for both of them. No, just if you've collected enough money that you're going to make a 14% yield, and be content with 7% and close it at that time. So this is just the template, just a simple set of rules, so that you can kind of now start taking yourself, whatever you want to do, write these down, print them out or whatever, and then alter the rules for your own kind of trading. Everyone does that, hopefully, because everyone's different. Let me read a comment here while I sip some coffee. And what's the next slide here? Okay, you guys look at that slide here. Let me read this. Just a second. Yeah, Brian had an interesting idea. Okay, we'll talk about that. Are you permitting multiple? John asks, are you permitting multiple simultaneous bullish or bearish spreads, or are you limiting the system to iron condors only? John, we're limiting it to iron condors only. Okay, now let me just take a look at the next slide. If I took a... Okay, so let's take a look at this. This is an example from October. And you could see the market came down. Clearly, it's about pretty much down at zero there. All right, so the market has come down. At that point, we're going to come out of the money here and sell premium, whatever it is, 42 days. At this point, we're going to... well, let's see. I think we began monitoring the market back here. It took a few days before it came down. I think we began monitoring the market here. Boom, it came down, and there we are. Okay, so what do we do then? Let's go and click next. Okay, there we go. And you see, it took us a few days there. We began monitoring the market on Friday, and it took till Tuesday when we had a big down day, and we're going to go to the first strike of under 10, sell premium there, and the idea here is that we got about $1.50. So this spread would have to go to $3 for us to close it out. All right, and if it does keep going down, well then we'll take our loss and go away. Now, Brian made an interesting suggestion, and then I kind of toy around with it, and I think that there's good merit. his idea, and I think there's good merit in this. Certainly you could do this. Let me see here. Let's, boy, you know, I am just fit to be tied with this little eraser thing. Okay. You know, his idea is to wait until, let me switch colors, wait until the stochastic pops up from under 90 or under 10 to over 10, or wait till it comes up here and goes down. Okay? Because the notion here is that the overbought conditions can persist for a little bit. I think there's good merit in that. There certainly is good merit. Now, mind you, it can kind of, on a 511, when it does switch over and drop, it can go from above 90 to, you know, 50 real quick. I mean, it can really come down fast and get into an oversold situation very, very quickly. So that's just something to be aware of, that sometimes it can happen in just a day or two. Like here, over here on the left, we're going from an oversold to an overbought, you know, pretty quickly there. Doesn't take much time, and so that first time you look, you can already be up. But I understand the alteration and suggestion and appreciate it. It makes a lot of sense. Paul is asking, do you get better fills on the Russell as opposed to the SPX? Well, it certainly the answer to that is it depends. It depends how you work the orders, and that's a whole nother discussion. And we, you know, within our organization, we have traders and mentors working both markets. Okay, using both markets. Now, and even then there's an internal debate whether using the 25-point strikes in the SPX because of their higher open interest is better. And one trader says yes, the other one says it doesn't matter. So also note that the Russell has less dollar volume dramatically than the SPX. And so I'm going to say, James, that it depends on the broker and it depends on the trader. Within our organization, we have traders using both, and they would contend both ways, to be quite honest. Okay, let's see. All right, so I'm going to keep going here. Let's see here. Okay, so there we go. We're going to come to the first strike of under 10 and sell it with a 20-point. And then we're going to, at that point, just look at and you kind of see the market's already come down quite a bit. We're going to come out here and sell the premium. Now, we're going to take this off when it goes from $1.50 up to $3. And, you know, as soon as, let's see, so as soon as we are losing as much as we can make, okay, actually twice as much, that's when we're going to get out. So you can see it's going to have to move pretty quick for us to get out of this thing. Okay? And along the way, the price is going to typically come up, get our stochastic up to the overbought level, and then we start selling up here. See that? So that's what happens now. The market then was down here with that bar there, chugs a little bit along, and then we hit right here where it now is up at the 100 mark. Now we're going to sell premium out here. Over here we sold down here. Now we're going to sell up here. And when we go and look at this mark here, we come to the first strike of under 10. Do a 20-point spread. And then when you analyze this, you now get your condor. So we legged into the put side first, waited till the conditions reversed and we were overbought, and then we sold the call side, and we've kind of have legged into it in those conditions. And then we wait, and at no point did this spread reach the $3 mark, and this spread also never reached its get out mark. And our trigger for getting out of this, let's see here, is that we now, let's see, are bringing in half of what our potential cash flow is. So we collected a credit of $2,300 total between the two spreads. We have $1,200 sitting on the table. We're going to go ahead and close the whole shooting match and be content with that yield. $1,200 on $17,007. Now, certainly, if you look at the graphic analysis, are you leaving a little bit on the table here? Absolutely. Absolutely. You're leaving something on the table. Now, mind you, you're getting out, and you have about 9 days remaining until you start the campaign in the next month, over in December. But that means you're out of the market. You have a good yield. You're out of the market before you start waiting for those conditions to begin again in December. And getting good yields and while you're not in the market. All right. I mean, there's something to be said for getting yield in the long run, month after month, and you're actually out of the market several days during that time, because then you're not putting it at risk. It would be better to get good yield with lesser amounts of time spent with your money at risk. Doug, no, we do not leg out. No, we're just taking it off. That's certainly you could. I think you could build an algorithm in and use the stochastic to perhaps leg out as well. I think that's something to definitely think about. So let me think though. How would you work that? If the market goes up, up, and up, well, at that point, you may want to take the put side off. Yeah, I'd have to think about that. If the market is overbought, after you put this on, it's overbought, it's likely to come back down. That might be a good environment to then take off the put side when it's overbought, and then you wait for the stochastic to go the other way, and then take the other side off. I think that there's something to be said for that. Deborah is asking, Steve, could the reverse logic work as well when the stochastic is around 50? Enter into both legs at the same time? Or have you found that waiting and legging into fine-tunes the profit? Deborah, I think you would want to wait until the intent here is to wait until you have one condition or the other, overbought or oversold, because then you have a greater likelihood that the market is not going to continue in that same direction, and it would behoove you to go ahead and do it like this. I think that would be the... Oh. Sounds like you expect to be in the trade for about 20 days. Yeah, I would say 2 to 3 weeks, certainly. Makes sense, yeah, something like that. In any case, we want to try and avoid the last 2 weeks there. That's that's a philosophy we have at Discover Options. Our forte isn't really playing with the weeklies and getting too close to the fire. We like to do a little bit more further out and grind out yields that way, rather than getting the short-term, from a short-term time frame, where your gammas and deltas get slopey and curvy when you get too close to the fire like that. Let's see, Doug is asking why we don't like to get too close to the fire. Well, certainly you can get higher yields if you get close to the fire. It's just that, to be honest, that's just our wheelhouse as a company. That's the mentors we brought in. We've conversed about it. We have students that are money managers, and their clients kind of want good solid returns every month typically, but with the volatility of those returns, typically in a money managed situation, the volatility of the returns is important, and it needs to be kind of on the lower end. And if you were to trade just the weeklies doing premium selling strategy, you can have some big losses. But generally, when you're dealing with options farther away from expiration, your gammas are flat. Your gammas are lower. That is, the risk curves are flatter. Okay, let me go back to this. Here we go. Okay, remember, gamma is the curvature of the risk lines. If you have a flat line, there's no gamma there. That's why here you have 0 gamma. Okay, but you know, the closer you get to expiration, the curvier and the more slopes you're going to see in these lines. Things can change very, very quickly. Okay, but that just seems to be our wheelhouse as a company, just to be honest, and that we've done pretty well there. Jack, what about margin with this approach? Well, Jack, it just depends. I mean, we're showing you Reg T here. Certainly, if you have a portfolio margining with your broker, that's going to be changed, and your margin requirements will be much lower than at that point. We're assuming a Reg T situation here. Did you try other time frames different from 511? Jim, no, I've stuck with the 511. You know, just it's a 1 week look back. That just makes a lot of sense. Let's see. You know, I had a suggestion here from Tony about using Bollinger Bands. We can be looking at that. This was just stochastics. Honestly, Tony, though, I have been doing more with our mentoring students with Bollinger Bands as of late, and I actually am going to talk about credit spreads in Bollinger Bands from a directional standpoint, not necessarily with condors, but I'm actually speaking on Bollinger Bands at the New York Traders Expo next month, and that's the topic. Will be on Bollinger Bands, although not on a condor type strategy, but certainly with credit spreads. Okay, now you might be asking, well, now what about the same if we had just put on a condor? So I wanted to show you, what if we'd have just stuck a condor on here at the beginning and not legged in? What if we'd have just done a static 42-day condor going out to the first delta under 10? Doing a potential yield grab, you know, at the same thing where we're going to grab half of it off when we have it available. What would that condor have looked like with a static and not legging in? Okay, so if with 42 days to go on that Friday before the Tuesday when we did this, we go out to the first strikes under 10, 20-point spreads. Put it on. We have, this is our cash flow, very similar to what we got when we legged it in. So we're looking for a gain loss, you know, of somewhere, what, 1150, 1160, something about 1160 bucks is what we're going to aim for there. And honestly, at no time between this Friday and then, you know, when we got the other one off, did that happen. And so if I show you the next slide, okay, here's where it began. And on the 31st, when we took off the other one, okay, the other one gave us our yield of 1,150 bucks or more, and this one was at 850. Had lower yield levels, and I thought on the other slide I had, yeah, I didn't have the risk graph there. But in any case, the static condor underperformed the legging in approach in this particular instance. Now look, you need to know on the downside of this, and Brian brought it up earlier, and then that is this. Let me go back to a chart. Okay, let me just dial it back to a chart, because this is important. You know, you can have a situation where the market, and do we have it here? Where the market achieves a high, a 5-day high like right here, and then you sell a call spread up here, and then look how long it takes to come down all the way to there. I mean, the market stays in its overbought position and goes up. All right, and this would have resulted in a loss. And you know, gosh, you know, I'm preaching to the choir here. You guys know every trading approach, all right, will result in some losses. And you need to be aware of this. Now, in this situation, the call side would have lost money. It just would have been a losing campaign. Now that would have been, had it been right there. Now, I think, if you looked at the 42 days and began doing that, but you should just know it's possible that that had you entered there, you would have had a loss in that particular situation. Okay, and I just, at the risk of sounding silly stating the obvious, I thought I'd go ahead and state the obvious anyway, just as just to make sure you go into it with your eyes wide open here. John is asking an interesting question. How can OptionVue be used to find stocks with high IV options and a wide range of swings? And how does IV play into picking the condor? John, OptionVue is great for doing all of that. In OptionVue, there are two tools you could use. One is called Survey, where you can survey all of the volatility charts in OptionVue that it keeps, and you would look for both high implied and high statistical volatility stocks. Okay, and how does IV? And the other tool is called OpScan, and that allows you to customize a set of parameters to go scan the volatility data in the OpScan database. And in OpScan's database, we keep the volatility info, implied and statistical, on every stock index and future, as well as on specific options. And it's kind of an Excel spreadsheet type language you learn. You can create your own customized scan and go and query that huge database, and it gives you returns on what you look for there. So again, that's Survey and OpScan. How does IV play into picking the condor? John, the higher the implied volatility, okay, then the greater yields you can have relative to how far out of the money you go. All right, so it plays a direct role in the yields that you can make relative to how far out of the money that you go with your spreads. Now, here's the deal though. Quite often, high implied volatility is high for a reason. So if you're going to do this in specific stocks and you have a stock with very high implied volatility, it behooves you to understand completely why it is that that stock has a high implied volatility. All right, and it might be due to an FDA announcement expected to come out any week. It might be due to earnings coming out, or it might be due to rumors of a takeover. Any number of things can make that implied volatility very high. A history of big movement on earnings is another reason. Okay, John? All right, thanks. Let's see. Let's see. Let's see, G. Adkins, what about with volatility so low that if you sell a credit spread at this time and then volatility expands, then the spread prices will increase and losses will incur? Well, a degree of implied volatility risk, it's called Vega Risk, and that does exist with a condor. Now, your Vega Risk is mitigated because you are long strikes further out. In other words, you've sold some premium, then you've bought some premium, and you're capturing the spread. That spread is susceptible to movements in implied volatility. Okay, and that is a risk that you should be aware of. No question. Now you should know that in OptionVue, when OptionVue analyzes a screen like this, if you're using OptionVue, you should know these lines. Oh, let me get my eraser here just a second. Boom. All right. Oh, this is the kind you have to wave it around. Oh, no, let me do the little trash can thing. Just a second. Boom, there it is. Know that these lines here, okay, include shifts in implied volatility. In other words, if the Russell were to plummet really quick, all of a sudden on the T+0 day, that's this dotted line here. Okay, and let's say in one day it goes from 835 down to 771. Okay, and it shows that you're going to lose probably 20-some% right there. That particular data point, that loss that's being projected right there, is including the notion that implied volatility is going to rise. See that? And in OptionVue, we call that constant elasticity of volatility. And you should know OptionVue is, to our knowledge, the only program that will, available to the trading public, that incorporates CEV, constant elasticity of volatility like that. We're actually throwing in an estimation of how much vol is going to go up. Implied volatility is going to rise on a one-day move that dramatic. See that? Okay, so it definitely is a risk, but that's why we graph this out in OptionVue so that we're aware of how much we could make or lose. Okie dokie. All right. I don't see any other questions. Okay, let me click on here. Boom, 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 boom. Oops. Next. Let's see. Okay, let me go to the next. Okay. With the volatility at historic lows right now, would you give it some time for things to get better, to get further out with a better credit? Paul, that's a tough question, and you know, some people look at the VIX as something static like that. But you know, the VIX can go low and it can stay low for a long, long time, and you could theoretically be out of the market for a long time. Meanwhile, months and months could go by and you would have had some great condor trades. All right. Really, the best way to look at the VIX, or where the implied volatility of, say, the cash SPX options is kind of a measure. The best thing I've seen that uses the VIX would be looking at the VIX relative to its 10-day moving average. When it gets too far away from that, it typically goes back the other way and snaps back like a rubber band. And it's predictive of the underlying market maybe 3 to 5 days out. It's a short-term indicator at best. We don't really subscribe to the notion of treating the market differently if the VIX is above or below a certain level, because we know it can go high and stay high, or it could go low and stay low for a long time. And so that's kind of how we like to treat it, is more of a short-term predictor from the rubber band effect there. Okay. By the way, folks, those of you that are looking at all for education want to make sure you have our contact information there. Let me look at another question here. Greg is asking, any thoughts as a way to hedge the Vega Risk with the Condor, or did you just have to accept the risk? Well, yeah, Greg, you know, in a Condor, you really are hedging your Vega Risk by buying those long calls, or the long options further out. Now, one thing you can do is buy more of those further out, would hedge your Vega Risk. However, it would reduce your yield quite a bit as well. All right, so that is something to consider. If you wanted to reduce your Vega Risk, also you would actually have gamma that would get flattened that way, as if you were to purchase a few more, you know, farther out of the money options. It would reduce your yield, though. So it's a reward. And what we like to do with our company and the way we teach, we like to keep it simple. We'll accept the risk. We're aware of it, and we've built our adjustment parameters around that. Okay, we like to adjust our condors, you know, without a doubt, and we have our own way of doing it, and we certainly talk about that routinely with our students. How do I get help using OptionVue more effectively, says John. John, if you're using OptionVue, you could look at the, make sure you go through the tutorial videos available. Also, there's some OptionVue essential classes you could certainly look at. I would go to the discoveroptions.com website, click on the education link, okay, and you could look at some of the webinars available there that have been archived. And ultimately, John, you could call and talk to your rep here in the office and tell them your situation, and they'll have some suggestions for you as well, okay, relative to exactly what you're using OptionVue to do. Len is asking, is there any indicator to keep you out of an iron condor when the market is trending strongly, like in 2008 or 9? Len, we have I created a volatility indicator that helps to that helps to just understand the volatility level of the market. And maybe next time I get with you guys on a Monday, I'm going to explore that. It's called the Lentz Volatility Indicator. And I think maybe next time I'll go ahead and explain that. But we have built that indicator into OptionVue, and what it does is it looks at the trendingness of statistical volatility, and it determines whether now would be a good time to enter into a condor or not from a volatility perspective. Not from a directional overbought, oversold situation, but from the perspective of how volatile the market is right now and whether that volatility is getting higher or lower. And that's an indicator that we've built into OptionVue just for that purpose. So thanks for prompting me on there. Don is asking, what does OptionVue cost, including data fees? Boy, you know, that's a loaded question because we have a whole bunch of different specials going on at any one time. And the best answer to that, you know, and maybe, let's see if, you know, we need to talk about whether this should, see, I'm not into the, I handle the mentoring portion of our program here. And at any given time, we're offering different specials on that, and we really like the conversation along those lines to be done with the one-on-ones. If you were to call and talk to a representative here and a consultant, they could certainly quote you a package relative to exactly what you need. Thing is not everyone needs the same package of data and software. Some need real-time, some are content with delayed, and so we need to kind of see what your situation is. Okay, but I would ask you, Don, to call our office and talk to someone here. KB, will the recording be available to review? Yeah, I think we are going to post this. Yep, we could certainly post this. It will be available. Now, that's a good question. Let me think here. You know what? It will be available. I'll just say that. And I'll talk to Jim and Jeremy here as to how we're going to make that available. But we have a whole bunch of archived webcasts at the discoveroptions.com website. Go to the Education tab and click Archived Webcasts, and you'll see the link to a whole bunch of real good webcasts we've done in the past. Okie dokie. Folks, thanks so much for joining us. I appreciate you attending. Next week we'll have one of the other mentors available here and teaching a great class. Look forward to speaking to you later. Take care. Bye-bye.